Hello, good morning, viewers. Good afternoon. My good morning to those who are other parts of the world. My name is Albert Ruemam. I'll be the moderator. I'm a senior credit and political risk insurance underwriter based in Nairobi. With me, I have four panelists who will join me in this discussion. The subject is the structured LCs, which we did in West Africa. We thought it would be very good to do it in East Africa. To start with, George, can you tell us briefly what does this LC structured LCs mean?
Okay, really to start with, just to give the audience some context. I think we were just going to start with a polling question, just so we can take the temperature of the audience and see, the extent to which we need to explain exactly what they are and etc. So perhaps we can go to the polling questions, please. So the first question is, have you been involved in structured LC transactions previously? So if you'd like, please, as audience members, to vote either yes or no. At the moment, it looks like every member of the audience has been involved in structured LCs. Oh, there we go.
Yeah.
So we'll just give you a minute to make your election there. Okay, so I think, right, we're about 3/4 of the audience has been involved in structured LCs. It's hovering around there, Alfred. And then if we could just move to the second polling question, please. Are structured LCs trade finance? Yes, they are used to finance trade in emerging market countries and enjoy trade regulation and UCP support. Or no, they are over-engineered general financing products. Or the third possible option is, I don't know, I'm not entirely sure what they are. If you'd like to make your selection now, please. Okay, and the end result of that seems to be around about 60% think that they are structured LCs are trade finance. About 15% think that they're not strictly trade finance, and 20% are unsure about exactly what they are. So with that context in mind, we'll just give a brief, given the limited time, a brief introduction as to what structured LCs are, and then continue to the panel discussion. So they're an instrument, a trade instrument, that are not generally well understood, and there isn't actually a great deal of literature or explanation in the cyberspace to explain exactly what they are, and they can be seen as being somewhat difficult to understand and a little bit mysterious. I have contributed my own humble ITFA article on the topic, which I hope, Albert, we're going to be able to put on the chat. It goes into a lot more detail around structured LCs, particularly in Africa, and it really serves as an abstract for the much more comprehensive ITFA white paper on structured LCs. I would recommend that anyone who is interested and wants more information on the product does look at the ITFA white paper. It's obviously the only real authoritative work on the topic, and it can be accessed via the ITFA members' website. Now, this is where the ITFA plug comes in. There's a really good reason to join ITFA, as it is the sort of globally influential industry body, and we have an African regional committee, an ARC for ITFA, which can be joined to give access to all of the benefits, including lots of training, these types of white papers, and as well as conferences, etc., and really to give Africa a bit of a voice when it comes to trade finance and forfeiting. There is an African regional committee, as I say, and we would invite people who are interested watching this panel discussion to join the ITFA community, and one of the benefits will be that you will have access to this much more comprehensive ITFA white paper, as well as other materials. So moving on from the ITFA plug, there is no real strict definition of structured LCs. They've in their technical composition, they may exhibit a number of telltale signs, but no real easy definition is possible from all of the mutations and the evolutions that the product has gone through, save for really their commercial purpose. So there is a reasonably clear commercial purpose differentiation, and that's between where traditional vanilla LCs usually relate to a specific cargo, and they're designed to manage the credit risk of specific cross-border international trade transactions, as well as often provide appropriately priced financing of a buyer's credit payment terms. Whereas the commercial purpose of a structured or synthetic, sometimes transit, sometimes prepaid LC is really as an alternative form of a US dollar short-term trade liquidity, borrowing for emerging market banks in order for them to fund their trade portfolios. As far as the basic modality is concerned, and perhaps now we could just have the diagram. This does look a little bit complicated, and I won't go through it in a lot of detail. Really, the important features are the basic parties, which are shared between both traditional vanilla LCs as well as structured LCs. And there you have the applicant buyer, you have the issuing applicant's bank, you have the beneficiary seller of the cargo, and the confirming and often, and in structured LCs, discounting beneficiaries bank, seller's bank. So out of those four parties, that they're shared between both traditional LCs as well as structured LCs. And in structured LCs, one of the telltale signs is often that the applicant and beneficiary, the buyer and the seller of the subject cargo, are often intergroup companies or related parties. Unlike normal usance term LCs, where the issuing bank takes the applicant's repayment risk for the full tenor of the instrument, structured LCs typically arrange for the beneficiary to pay the LC discounting proceeds from their confirming bank to the applicant, because they are intercompany, are often related parties. The applicant then places those dollars as a deposit with their issuing bank, effectively prepaying the LC, and that's where the liquidity for the issuing bank is generated. There are lots of variants that have evolved over the last 30 years, while structured LCs have been, or synthetic LCs have been prosecuted in the market. But they typically involve relatively large amounts, deferred payment tenors of 180 or 365 days, 360 days. The location of the LC participants and those four parties often don't relate to the geographies of the cargoes, which is unusual for traditional LCs. And copy documents and copy transport documents are almost always deemed to be acceptable. Stale documents and late shipment is acceptable, which is very unusual for normal LCs. And they're usually marked by the issuing bank being in an emerging markets jurisdiction. As far as how they relate and why they're important for this particular discussion in East Africa, is that point around them being an alternative African trade liquidity source. And why that's important is to do with trade regulation, particularly bank regulation, as well as the African trade gap. So just to briefly look through that, the trade is typically, particularly cross-border international trade, is typically denominated in US dollars and short-term US dollars. East African US dollar liquidity is expensive, and often treasuries who are providing that liquidity into trade transactions, their treasuries will find it difficult to match short tenor dollar liabilities with relatively short tenor trade assets from a tenor perspective. There is a solution for that, which is very common in East Africa, and that is trade refinance, where trade dollar liquidity is offered by often international banks, maybe DFIs, etc., in order to refinance specific trade assets, and that can be a very effective source of this scarce and expensive dollar liquidity. Unfortunately, that's only really good for large lumpy assets and of relatively long tenor. And the harsh reality is that real trade portfolios in East Africa and across the continent are comprised of relatively few very large, lumpy, long tenor assets, and lots of real SME trade assets, which may be very small and very short in tenor. Unfortunately, they still need to be refinanced, or they still need to be financed, and liquidity needs to be sourced for them. Trade refinance can't fill that gap. And this is where structured LCs are the best possible solution, particularly for East African banks, and for regional and lower tier banks as well, where the liquidity that structured LCs deliver will offer that liquidity in order to finance these smaller SME type assets, trade assets, and close the trade gap. And that's particularly important, again, in East Africa and on the continent more widely, where there is some strain, and particularly after coronavirus, on the FX liquidity that's necessary in order to fund these largely US dollar denominated assets. Albert, that's the...
Thank you so much, George. I mean, that was so detailed, but that's very important for us, because remember, we are in East Africa, we're operating in a market where structured LCs are not very well known. Perhaps we are using them. Most banks, most likely they're using them, but they may not necessarily know how they're called and whether there are regulations, enough regulations actually to operate in. It's really, we seem to think it's murky and they're operating in a very uncontrolled environment, which may not necessarily be the case. Now, thank you so much for the detailed introduction. Now, I'll go back to our first panelist, who is Sarim. Sarim, I mean, you're very experienced when it comes to structured LCs. Could you please tell us the evolution of the structured LCs?
Yeah, thanks, Albert. I think, as George mentioned in his intro, the structured LC is used to provide financing to a party. Usually that party is the issuing bank, but there are different variations of the product that do exist, whereby finance could be provided directly to the buyers by commodity traders or corporates. So over the years, we have seen that structured LCs have continued to coexist alongside your commercial banks and your DFIs in this trade finance ecosystem, and they have to some extent address the trade finance gap that has been created by perhaps correspondent banks withdrawing their support, as well as the level of bank intermediated trade finance that we know has declined over the years, particularly to SMEs operating in high-risk sectors like agriculture, manufacturing, etc. So as a confirming bank, it is important that the bank understands the purpose of the product end to end, the parties that are involved, as well as the motives and the risks associated with each party, and thereafter develop frameworks and parameters that talks to, firstly, why the bank wants to participate on the structure and how the bank will participate in different jurisdictions. So I think I just will maybe just highlight a few motives and aspects that we have considered as a confirming bank, and we continue to consider these as and when new entrants that want to actually execute this product approach us. In terms of the corporate or the commodity trader, the motive is to generate a profit for the group using their underlying trade flows. So we prefer that the corporate does have a proven track record of execution in the market. There's also demonstrated settlement in these markets, and there is large trade activity taking place globally in the region or in the market. Another aspect that we do consider is whether the corporate has a physical presence in that market. So is there a linkage to the issuing bank? Is there supply in the market? Are they considered a critical source of supply? So that does help us to build a narrative around how the USD that is being deployed via the structure is being used to help the trade value chain in this particular market. And I think we're also quite conservative on the fact that we want to understand from a corporate as to whether they have considered any legal issues, any clawback issues, any reputational risks, and are they willing to be associated with these for whatever reason. Perhaps maybe from our motives, why do we want to support this? And that is to be able to capture commercial flows as well as other ancillary opportunities that may exist with these corporates. So a sort of a pay-to-play strategy. And to ensure that we have some balance in the portfolio. So we just don't want to be confirming just structured LCs. In regards to the issuing bank, as George mentioned, the purpose is to receive access to the USD. So from our perspective, we also would treat this as diversification of funding products that we provide to the issuing bank, alongside your trade loans, your LC refinances, secured loans, etc. And we would then sort of seek to allocate the portfolio accordingly. So I just maybe we'll stop there in terms of some of the motives as to why we participate on the structure. Thanks, Albert.
Thank you, Sharina. Thank you so much. That's very detailed in terms of the transaction and how it's actually, in terms of the LCs and how they are actually structured. Now, if I go back to Afolabi, looking at how DFIs can actually come in and support, structured LCs, Afolabi, will you be able to tell us how that the institution like Afrexim comes in the whole, structured LCs?
Thank you very much, Robert. With us at Afrexim Bank, part of the reason why we are doing structured LC, as you are all aware, Afrexim Bank is a trade finance bank with a mandate to promote intra and extra African trade. Today, Afrexim Bank do a whole lot around trade finance. We have a trade facilitation program, which are plain vanilla trade finance transactions which we support. And part of our instrument of intervention is also to do risk bearing. So when we consider structured LC, we look at it as a confirming bank and sometimes as a discounting bank. And that way, what we are doing is to leverage using our credit rating to provide, to serve as a de-risking tool for counterparties like commodity traders that want to do business in Africa by leveraging on our credit rating to provide financing to support African. Africa does not do money market placement for issuing banks in Africa. And we think that with this particular product, we can support issuing banks in Africa to create liquidity to support the underlying transactions that they want to do for their clients. Now, part of the things that we put in place as we are doing this is to be sure that they have matched transactions that they want to do. So if you have an issuing bank that is raising structured LC for a 1 year, we also want to see those transactions that will be supported within that 1 year to show the trade and development impact from our side. So one important reason why we are doing this is to create liquidity in the market. We are using this as a risk-bearing instrument, so we are guaranteeing by providing that confirmation services to the confirming bank, to the commodity trader, to be able to do transactions with the issuing banks in Africa. And this has been very well done because we've seen a whole lot of an increase in terms of the trade transactions that is going into Africa, and that has also increased reach and coverage in terms of new transactions that are being undertaken by issuing banks in this marketplace. So as an emerging market, we think structured LC is a good way of supporting our financial institutions in Africa, coupled with the other trade facilitation programs that we are doing as a bank. Thank you.
Afolabi, just to add on that, we had a discussion in terms of how DFIs we can actually work together. The likes of obvious Afrexim, FDB, and the ATI. We understand, of course, we need more capacity Can you explain on that, on how do you think we can actually collaborate and be able now to offer more capacity to African countries?
Thank you, Albert. Today, we may have headroom constraint on some of those institutions, and some of the things that we have even done with it is also to offload part of that risk to other counterparties when we have that constraint in terms of limit. So one of the ways we can work together is through risk participation. In terms of for the part of ATI, they can do a reinsurance. For the part of other DFIs, we can come together via an unfunded risk participation, because entirely this is an unfunded solution that we are bringing to the marketplace. So we can then do it via a risk participation to enhance capacity and to enable us to also manage our capital and also optimize capital. And that will also enable us to create capacity in the marketplace to do more for our issuing banks. Thank you.
Thank you so much, Afolabi. I mean, if I have now to move a bit in terms of regulations, I would like to invite our panelists. Simon, could you tell us, I mean, in terms of documentations, how structured LCs are working? I mean, we know we have issues where we think structured LCs are not necessarily acceptable. I mean, in your experience, what do you think structured LCs can actually be compliance of the regulations?
Thank you, Albert. I think just to start off with, I think it's important to say that in order for these types of transactions to work from a legal perspective, they do need to be properly documented. That's not just the LC itself, it's the underlying trade, because there is an underlying trade. It may or may not relate to the particular jurisdictions of the banks involved, but there is a trade and they have to be documented properly. Obviously, the real trade is between one of the two group companies shown in the slide earlier and the ultimate end buyer via a middleman, which is a second group company. But there does need to be contracts all the way along the line showing how title passes. It has to look like a proper transaction as well as actually have an existing trade to it. And I think, I suppose, what I'd like to look at is the potential risks involved in these transactions for the different parties, but focusing on the bank involvement, so the confirming bank and the issuing bank. And I think the reality is that it's really the confirming bank, if it's been properly documented, that is taking the financial risk in the transaction. So I'd like to start with them first. And I think fundamentally, they must understand how the transaction works and it must look sensible for the client's business. And as with any LC, they have to be comfortable with the reputation and market expertise of the clients and the other parties involved. And they have to do their due diligence. They have to look at the local regulations that may affect the structured letter of credit payments by the issuing bank. And the main risks involved really from their perspective are the risk on the issuing bank, any risks associated with that bank's jurisdiction, documentation risk, fraud, compliance, and then also looking at enforcement. And so just briefly to touch on these in turn, if we start off with the issuing bank and its jurisdiction, really the credit risk issue is the same here as it would be for a normal documentary LC, perhaps even slightly enhanced because the issuing bank has full cash collateralization or has been prepaid. So there ought not to be any issue if it's been properly documented with any challenge by the underlying applicant for the LC. But where there may be a potential increase in risk is because of the jurisdiction involved and the fact that the underlying trade may or may not be related to that jurisdiction. So from an FX perspective, you may get certain central banks or governments from the issuing bank jurisdiction raising questions about whether or not payments should be made when there's no perceived commercial trade benefit coming into the country. I think the first point to note here is, first, as I said earlier, do your due diligence to find out what their track record has been with this product in the past, but also to note that the way these transactions are structured, money actually goes into the issuing bank jurisdiction up front, either in the form of the cash collateral or prepayment. So whilst there might not be a trade benefit involved where goods or payments for exports come into the country, the actual dollars have already come into the country at the beginning of the transaction. So there really ought not to be any issue. And unless you see any specific tightening of restrictions and regulations, then there ought not to be a problem in practice, because reputationally, if nothing else, if they start to play games with FX restrictions and money coming out to the confirming bank, then they're going to find it difficult to raise finance on this basis and potentially on other bases going forward. Looking at the documents themselves, as I said, you really ought to.
Sorry, Simon, that's quite a crucial. That's quite a crucial part, which I think is often overlooked, and it's precisely on that point that structured LCs, rather than being a drain on what may be very scarce FX liquidity, dollar liquidity in the region or in that particular jurisdiction, structured LCs actually supplement that liquidity by pumping dollars into the jurisdiction. And you don't have to convert shillings into dollars in order for the LC to be repaid. Necessarily, the issuing bank is long the dollars for the duration of the LC and simply needs to repay them. So that is something which I think is often overlooked and maybe misunderstood, particularly on that FX liquidity point. Sorry, I interrupted.
No, and I think you're right, George. And I think the way that they need to look at it, and the way that they generally do look at it, is that this liquidity helps the local economy, because that money is ultimately going to be used to fund local businesses, local exporters. And if they can get capital relief for it as well, all the better. And I think,
and that's particularly important for regional banks as well, and in the region where a Kenyan issuing bank or a Kenyan bank offering an IRU over a Tanzanian issued structured LC, may have some misgivings around using their liquidity to pay for effectively pushing liquidity into their FX to cover liquidity into Tanzania, and structured LCs kind of short circuit that problem, and it's an important tool, again, particularly maybe in this region for regional banks who are in Rwanda, Tanzania, Kenya, etc.
That's right, and I think that's.
Kuku, maybe that's to intervene there. So we seem to all agree that the product, we need this product. Maybe the question is whether do we have a gap in terms of knowledge and perhaps maybe the technical bit of it. Why do we seem not to use the product? Maybe Simon, you can actually point out on in that area.
Well, I'll probably let the bankers talk about the relevant expertise in the market, but from an English law perspective, which is what a lot of these documents use, I think that there is an understanding of the structure and how it works. It's just a matter of, from a practical perspective, how do you make it work? How do you get all the parties lined up to do it? Because they all have to be involved. They all have to understand what's going on and all have to be comfortable with the structure, even, as I said, to the extent of the local regulators and the governments. And that's, I think, why they've taken the view that they're not going to restrict this business because people are doing it. It may be that they could be doing more, but they are doing it. And their role is seen for the most part as one of monitoring and ensuring that those issuing banks that get the liquidity use it efficiently and properly for the benefit of the jurisdiction that they are in. That's where their real benefit to the local economy or the regional economy lies.
But Simon, so there have been issues, right? There, maybe in Azerbaijan and not in East Africa and not even in Africa, but there have been some issues. There is some precedent and case law which may have introduced some uncertainty or discomfort with parties who would otherwise use structured LCs or use them more. Would you agree with that?
I think yes, but again, to me, it comes back to, is it being properly documented? Because most of the instances I'm aware of where there have been problems have been because there has been either some sort of blatant fraudulent activity, or there has been a lack of understanding of the need to properly document transactions so that it is not treated as some sort of sham. And you can very well understand how you might get transactions where people say, well, actually it's party A selling to party B. Yes, we've got party A's intergroup affiliate involved in the transaction, but we don't need to put commercial documents in between them. It's all being dealt with between the two end parties. Let's just get the LC in place and that's how we'll do it. And it's I suppose for a lack of expertise or understanding of what is required to make sure these things do work because they are properly documented may be an issue. In other instances, I'm sure there is some lack of understanding of exactly what they are, and people will look at it and just go, no, that doesn't look right. But actually, if it is done properly and it is linked with an underlying trade and everybody is aware of what's going on, from an English law perspective, there's no legal reason why these things cannot be done.
Simon, if we have to bring, Serene is a transaction, and I know, of course, based on our experience, if you can give us examples of the challenges which perhaps can actually respond to some of the issues which are to do with documentation or regulatory issues. Serene, do you have, can you tell us?
Yeah, sure. I think, over the recent years, we've not incurred any issues with these transactions being settled on time, or has there been any sort of a halt by the regulators in terms of not classifying these transactions as trade obligations. So I think what is quite important, as Simon alluded to, is the structure of the instrument. So as a bank, you do need to ensure that it complies to UCP 600, is issued in an MT 700 format, which gives protection in terms of evidencing that there is an underlying shipment that has taken place between certain parties and the necessary contracts are in place. And also it allows for the necessary compliance checks to be carried out. The other aspect is full disclosure and transparency by clients. So, ensure that you've gained comfort with certain aspects, like the corporate, perhaps using the same shipment for opening multiple structured LCs with different institutions. That is something you need to be aware of and sort of build it into how you contract with the corporate or the commodity trader. I think this would also allow you to be selective in terms of which origination destination markets you support, and continuously monitor the credit risk profile of the issuing bank, because ultimately that is your source of repayment, as well as any regulations in the market that may trigger any sort of transfer risk or import restrictions. I do recall one example quite some time back where the flow of the funds back to the issuing bank was actually stopped for a period of time. But that was purely due to the fact that there was a lack of understanding of the transaction. And what did add to the complication was an intermediary bank being involved in the transaction in terms of the flow of funds. And unfortunately, the intermediary bank was not aware of the structure behind it. So it was difficult to for them to articulate this across. And hence, going back to my earlier comment of full disclosure and transparency with all parties in the transaction. Thanks, Albert.
Thank you so much, Serene, for that. Now, I know we discussed this, during the last session, the West African session, and what we found out, and obvious, I can allude to that, where I'm sitting, I've seen a number of transactions from West Africa on structured LCs. Now, this is for obvious George and Afolabi for that matter. Why do we think East Africa seems, of course, probably I'm right, seem to lag behind in terms of usage of this of this solution? We agree. It's actually very helpful in terms of reducing trade gap. George, if I'll start with you.
Yeah, so maybe they are less prevalent, and the volume of structured LCs is lower than in Nigeria, for example. But it is actually a relatively well-developed market in East Africa, particularly in Kenya. And we have seen a good volume flow and pick up. That might be to do with the traders and the traders' distribution desks, seeing richer pickings in Nigeria versus East Africa or any other jurisdiction. But we see that actually increasing. The volumes increasing, and the technical understanding and the context of them and how they're used, seems to be, growing, proportionately with the volume increase. Again, particularly in Kenya, there's no reason why that wouldn't, and their benefits shouldn't be enjoyed in other East African markets. I noticed. I'm covering for Albert because from a technical perspective, he's on his phone, and I can see some of the questions coming through. One of those. Yeah, a couple of those relate to two topics in relation to your question, Albert. Yes. One is there has been a development in East Africa, in particular, in relation to hybrid structures, which is a little sophistication on top of the probably more vanilla structures which are prosecuted in Nigeria, and then also around questions, in markets where there are FX control restrictions, such as Ethiopia. Maybe the idea is that there will probably be some repatriation limitations because of the FX restrictions in those regions, and that's where I guess Simon and my discussion earlier around the regional banks and the fact that they actually improve liquidity and they are not a draw on the FX. And FX limitations in those countries is relevant. That I think will develop over time, and regulators, central banks, as well as the underlying trading parties, obviously have to be comfortable with that they understand everything that's going on. But I think in those two important ways, probably. There are developments that are happening in East Africa that aren't happening in the rest of the rest of the continent, and as I say, particularly around those hybrid structures. I'll maybe we'll leave that to the end to answer some of those questions.
Yes, Afolabi, I'll give Afolabi a bit of opportunity to respond to the same question. But you are right. I guess also we've been discussing this. That there are different names. Most banks are doing the same thing, but they're calling it different names for different reasons. So, Afolabi, I know that we have actually worked a number of transactions together on this. Will you really explain on the same context? I mean, why do you think there's no uptick on the side of East Africa when it comes to structured LCs? And perhaps you have 5 minutes for questions, which George, I would like you to take a lead.
Okay, thank you very much, Herbert. I think George has actually outlined some of those issues, which I fully agree with. There is an issue around FX control in some of those markets. But I know that Kenya is quite advanced, and we've seen the increasing volume in Kenya. So the only thing that I will want to add maybe in terms of agreeing on the remuneration, because in terms of pricing generally, what the commodity traders may be looking at, some of them may not be able to close out on pricing with some of those banks in the East African market, given the low pricing regime in the particular market. But apart from generally, Kenya, we've seen increasing volume. Ethiopia, I think based on what George has said, has alluded to that part around regulatory issues, around FX control and some of those things. The other markets are still going, but with a lot of potentials to do more transactions. So if you look at it in relative terms to West Africa, we know that West Africa is doing a whole lot, particularly in Nigeria, using this kind of products. But we see opportunities in the East Africa market as you go along. Thank you.
Thank you so much, Afra. George, do you still have time? Because obviously I can't access the questions here. If you can actually bring up the question.
So I'll run through the questions now. If you want to do the questions now, or the polling question and then the questions.
No, let's start with the questions first.
Okay, so actually the first one's for you, Alfred. How does ATI treat structured LCs with local confirming banks where their international credit rating may be low and the LC is in euros or dollars?
Well, what we look at, thanks. That's a very good question, actually. We look at the underlying risk, and I think one important point which we didn't actually, talk about is how do we support SMEs? What we believe in ATI that, okay, structured LCs, as long as the bank is obvious working with us and we are happy with it, and that may not necessarily be on the rating issues, would mostly be the banks which understands our products. We are happy actually to support local banks, and we've been working with a number of banks across Africa on structured LCs. And the question of whether it's rated or not may not necessarily come up.
So the next question is talking about there's a question here saying, can these structures help provide financing directly to East African SMEs? I would answer that to say the problematic word there is directly. But as far as I can see in the market, there is a real gap in the financing capabilities for SME trade, and the solution to that is structured LCs. There really isn't anything else there. I guess the word directly would indicate that it would be going directly to the financing of East African SME trade assets. The issue there is that all dollars are fungible, and the doling out of those dollars is handled by the East African banks' treasuries. But I think that the answer to that question is yes. Then there's another question on please also touch on the tax implications on subject structures and effect of these structures on merchanting trade. Again, I'll quickly have a go at answering that. I think the point is that each of the traders involved in these structures necessarily undertakes jurisdictional, tax, legal, and compliance opinions and research in those jurisdictions, and it's not there isn't a one-size-fits-all solution, particularly as it relates to tax, as they differ from jurisdiction to jurisdiction. But if it is being offered in that region, transit trade is being offered in that region, then there is in all likelihood, although the traders won't share that legal opinion with you and that tax opinion with you, it would seem to be effective in that jurisdiction. But it's not really possible to answer that on this panel, across all the regions globally. Can structured LCs be used to externalize debt? So Shalina, I guess this goes back to the hybrid question.
Yeah, I think as I mentioned quite early, there are different variations that do exist. I suppose I'm not sure if the person asking the question is coming from the context of subsidiaries sort of being in country of these corporates, commodity traders, but it's certainly something that we have not got to as yet. But most certainly, if there is a variation out there, I'm sure it is being used.
So I think the short answer is...
Thank you so much. I mean,
probably yes.
We need to wind up. George, sorry, we need to wind up. Our time is up. I would like really to thank all of you. I mean, I think it's now clear. I mean, LCs have been in the market for almost 30 years. There's significant, increased, access to liquidity, especially on the Forex. We think we need to continue with this conversation. It's very important, especially for East African, audience, East African banks, to make sure that they also make use of this. And of course, as George have mentioned, it's important for banks to join. It's important in terms of education, in terms of knowledge and networking. Thank you so much. And I think we end up here.